The US banking industry just got hit with a tremor, one that could trigger a new wave of consolidation across American finance. Fifth Third Bancorp, one of the country's biggest regional banks, has announced a $10.9 billion merger with Comerica, a deal that could reshape the future of regional banking in the US. At first glance, it might look like just another merger. But beneath the headlines, this deal tells a bigger story about the squeeze on regional lenders, the rise of digital banking, and how AI and higher interest rates are forcing the industry to evolve or die. Let's break down what this really means, not just for Wall Street, but for Main Street. Fifth Third Bancorp, based in Cincinnati, manages more than $225 billion in assets across the Midwest and Southeast. Comerica, headquartered in Dallas, adds another $90 billion, serving customers in Texas, California, Michigan, and Florida. Together, the combined company will control over $300 billion in assets, instantly becoming one of the top 10 largest U.S. banks, right alongside PNC, Truist, and U.S. Bank. This isn't just about getting bigger, it's about staying alive. Regional banks have been under enormous pressure since the Federal Reserve began aggressively raising interest rates in 2022. Those hikes, meant to fight inflation, also made it harder for banks to borrow cheaply. Deposit costs surged, bond portfolios lost value, and loan demand cooled. The collapse of Silicon Valley Bank and First Republic last year exposed how fragile some regional banks had become. That shock forced institutions like Fifth Third and Comerica to rethink their futures. And for many, the answer is simple: merge or get left behind. Merging gives these banks the scale they need to compete with giants like JP Morgan and Bank of America. It means combining balance sheets, reducing costs, and expanding digital capabilities to keep up with today's tech-driven customers. This deal also reflects the re-regionalization of American banking. Big national banks dominate deposits and technology. Community banks thrive on personal relationships. That's left mid-sized banks stuck in the middle. Too large to be nimble, too small to compete with Wall Street's resources. Fifth Third and Comerica are trying to break out of that trap by building a new kind of regional powerhouse, one with enough size to innovate, but small enough to stay customer-focused. Their strategy centers on middle-market clients, businesses too big for local banks, but too small for multinational lenders. It's a lucrative niche that's expanding fast in cities like Nashville, Dallas, and Atlanta, where both banks already have deep roots. But the bigger story here is technology. Fifth Third has been investing heavily in artificial intelligence. From risk modeling to fraud detection and customer service automation. Comerica brings a strong commercial banking network and a solid base of business clients. Together, they can scale AI-powered services across industries, using data to make smarter lending decisions and improve customer engagement. That's where the future of banking is heading. Not more branches, but more intelligence. And speaking of branches, this merger will mean consolidation. Many locations in overlapping markets will likely close as the bank shifts to a digital-first strategy. That's painful for local workers and communities, but it's also a reflection of how banking is changing. Customers are moving online, and physical branches are no longer the core of profitability. But not everyone's celebrating this deal. Critics worry it will reduce competition, limit lending to small businesses, and make the banking system more concentrated. Regulators at the Federal Reserve and FDIC are already expected to scrutinize the merger closely. After last year's regional bank failures, Washington is cautious about letting any one institution grow too large or too complex. That brings up a crucial question. Could mergers like this create new, too big to fail banks? Potentially. When regional banks consolidate, they become harder to regulate and riskier to unwind if things go wrong. That's why the Fifth Third Comerica deal will likely face tough oversight before it's approved. Still, the market seems optimistic. Investors see this as a smart defensive move that reflects where the industry is heading, toward fewer, larger, more tech-focused regional banks. In a world where digital competition and regulatory pressure keep rising, scale isn't a luxury anymore. It's survival. And this could just be the beginning. Analysts predict this merger could spark a new wave of consolidation across the sector. Banks like KeyBank, Regions, and Huntington may soon follow, creating a new class of super regionals, banks large enough to dominate regions, yet nimble enough to compete nationally. In other words, the middle tier of American banking is being rebuilt. And make no mistake, this isn't just about surviving the next economic cycle. It's about redefining the future of finance. Fifth Third and Comerica aren't trying to compete with Wall Street. They're carving out their own lane, one where AI, digital transformation, and regional strength come together. If the deal goes through next year, it will mark the creation of one of the most influential banking institutions in the U.S. heartland, a symbol of how fast the financial landscape is consolidating. The big takeaway: this merger is more than a business deal. It's a snapshot of the new American banking order, one built on technology, scale, and adaptation. The message to the rest of the industry is clear: evolve fast, merge smart, and use tech as your engine, or get left behind. Because in this new era of finance, the real competition isn't between banks. It's between those that can reinvent themselves and those that can't.